Tesla reporting second quarter earnings on Tuesday after the closing bell, and investors will be looking for any new information about Tesla's much anticipated robotaxi event. But how many people are even using full self-driving in Teslas now? For more, we're bringing in George Gianarikas, Managing Director at Canaccord Genuity. George, it's good to see you. Obviously there has been a lot of focus already on Tesla's margins, on the fact that sales have not been fantastic, not just of Teslas, but of EVs more generally. So let's start there and what you expect to hear from the company.
Hi, thanks for having me. Well, we already gotten a glimpse as to what Tesla's deliveries were for the second quarter. The incremental news that we'll get from the call will be, as you alluded to, the margin trajectory of the firm, how exactly what appears to be a gangbusters quarter in their energy storage business translated into profits. And really importantly for us is the FSD take rate. Yeah, so if you remember during the quarter, they lowered the price of FSD to about $8,000 if you're paying a license, $99 a month if you want to buy the recurring revenue portion, the subscription, and they also give people a month free. Well, how is that translated into consumer appetite for the product? That's really, really important because for us, before robotaxi even happens, we have to figure out what the consumer appetite is for full self-driving offering that they have available to them today, particularly when that'll help dictate the earnings trajectory of the firm for the next few years before robotaxi kicks in.
The excitement around artificial intelligence is fueling the market to brand new heights, mainly thanks to the Magnificent Seven. The seven tech giants are witnessing an incredible 2024, with the majority of them up year to date. But that doesn't mean that analysts don't have favorites, as they try to see which stocks of the seven are great buys and which are sells. One major fund that recently made a controversial trade is the asset manager of Norway's largest bank, DNB Asset Management. The firm trimmed its Nvidia holdings when the stock was outperforming the market to load up on Tesla stock when it was lagging behind. In today's video, we're going to explore the motive behind this move and talk about whether investors should follow suit and sell Nvidia in favor of Tesla. But first, if you want to keep up with Tesla's latest updates and keep up with the stock market's latest news, you can follow our Twitter account. We post multiple times daily about the biggest changes and catalysts in the market, so click the follow button if you don't want to miss the newest market updates. Now, back to today's video.
Tesla stock has been on a tear. Its 11 consecutive winning sessions helped the EV maker regain all of its lost ground so far this year until today. Tesla's robotaxi event, one of the drivers behind that stock's recent run-up, has reportedly now been delayed by 2 months, sinking the stock back into negative territory for the year. Joining me now is Doug Clinton, Deepwater Asset Management Managing Partner. Doug, it is great to have you on the show. So let's dive right into this headline, Doug. So reportedly, maybe Elon Musk thinking of delaying this robotaxi event, Doug, to October. In your opinion, you know this company so well. Big deal? No deal? How do you see it, Doug?
Well, Josh, the first thing I would say is nothing is official in Tesla land until you hear it from Elon himself, because what sort of led to this event in the first place was a Reuters report several months ago that the Model 2 was going to be canceled. Elon said that that is false, and then he followed up saying that we're going to have a robotaxi event in August. We haven't seen Elon tweet anything yet. I just checked before we jumped on air here. He hasn't said anything about the event yet, so who knows what could happen. But let's say that the event is delayed, in fact, to October. In my view, what the stock has been doing more recently is it's been reflecting the hype and the excitement that investors are having for Tesla and what might come in terms of this robotaxi and what that ultimately might mean for the model. And Tesla, more than any other stock, is such a powerful religion. And I think that investors, as they see these new products coming, not just the robotaxi in October, but probably a few new vehicles as well, I think people are starting to figure out what could this mean to our models. And they were sort of front running potentially some changes in terms of how analysts and investors think about that business.
DNB Asset Management currently has about $88 billion in assets under management, so analyzing its recent trades could prove to be useful for investors. In Q2, the fund sold 908,000 shares of NVIDIA after the chipmaker's shares surged 150% in the first half of the year, compared with a 14% rise in the S&P 500 index. Like many other NVIDIA stock investors, the fund manager probably thought that it was time to take profits, and this turned out to be a good call, as NVIDIA stock ended up dipping thanks to a sell-off that was likely due to profit-taking. Notably, the fund also bought around 150,000 shares of Tesla stock, bringing its stake in the EV maker to nearly 750,000 shares. And this turned out to be the right decision to make, as Tesla shares have nearly wiped out the entire year's losses with a 25% rise. But does that mean that NVIDIA stock is now a sell, or that Tesla stock is a buy after its massive rise? Let's find out. Hello everyone, and welcome back to Investocracy.
Our next guest calls it a non-event, believing the EV maker stock is going to double. Joining us now, Deepwater Asset Management's Gene Munster. Gene, why is it a non-event? I mean, if there's any history here, it's a history of delays and of unfulfilled promises when it comes to full self-driving.
The history is the reason why this is a non-event is that they occasionally postpone their actual events. Keep in mind, Elon kind of did this off the cuff, announced this event out of a reaction to a Reuters report about a discontinued low-end vehicle. And so I think that was hastily planned, but they typically or sometimes delay these events, but they always, and I choose that word carefully, delay product announcement or product launches and the subsequent ramps. And if you look at that breadth, is eventually they will get acceleration from these products. As far as FSD, that undoubtedly is still this question that is begging, that's been delayed. Elon famously in 2017 said that FSD would be available by the end of the year. And at their first AI event, he talked about 1 million robotaxis in 9 months. So it's a non-event, David, because this is a very well-traveled road. And ultimately, the reason why the stock is rallying back here is investors are asking a simple question. Do they believe that transportation eventually is going to have an autonomy angle to it? And what is Tesla's position? And my view on that is absolutely, in the future, transportation will be autonomous. And I think Tesla has a pole position in terms of capturing that opportunity.
There's no denying that NVIDIA is the AI chips market leader, with an 80% market share. The demand for the company's chips is so high that its revenues and earnings saw extremely impressive growth. But NVIDIA's current PE ratio is around 70, and that is well above the NASDAQ 100 index's multiple of around 30, leading some Wall Street analysts to question the company's ability to sustain its strong rally. In fact, the stock's median one-year price target of $130, as per 62 Wall Street analysts covering the stock, also indicates that it's unlikely to deliver more gains. However, this doesn't mean that investors should be selling their NVIDIA shares. Although NVIDIA stock looks expensive right now, at least when compared to the broader index, it would be wrong to judge the stock's valuation just by making this comparison. Keep in mind that the company reported a 262% year-over-year increase in revenue in fiscal Q1 to a record $26 billion, along with a 461% increase in adjusted earnings. And to put these numbers into perspective, the S&P 500 index's earnings grew an estimated 7.1% in Q1 of the calendar year. As it turns out, NVIDIA's rapid earnings growth is why its PE ratio has dropped in the past year, signifying that it's been able to justify the premium valuation. In fact, the company's forward PE ratio of 448 isn't too expensive considering that the American tech sector has a similar earnings multiple. Therefore, we believe that selling NVIDIA stock based on its valuation alone isn't a good idea, especially when the company's fundamentals remain intact. That's why investors should still hold onto their NVIDIA shares. But what about Tesla? Well, we also think that Tesla is a must-own stock, and we're going to walk you through why we believe that right now. But first, if you made it this far into the video, thank you. These videos take a lot of effort and time to make, so if you enjoyed them, please hit the like button and subscribe to the channel. This goes a long way in helping us grow. That said, back to the video.
So it doesn't matter as much as whether it's coming. It doesn't matter as much as when it's coming, Gene. I mean, I would think for a discounted cash flow model or anything else you want to sort of try and determine value, you've got to have some date in mind where this is going to actually begin to contribute to revenues and cash flow.
You do, and it's probably 27 or 28, and I just want to put some context. You mentioned earlier about the potential for this stock to double. Right now, the company is going to do about $100 million in revenue. By 2027, that will be about $100 billion. By 2027, that should be $170 billion. An 8.5 multiple on that, that's a similar revenue multiple that Apple gets, kind of yields a double from here. But I think that that's kind of the year that investors should be focused on is 2027, which means we're probably a year away from fully discounting that. But keep in mind that 2027 benefits from two factors. First is accelerating demand for vehicles, whether it's for consumer-owned vehicles or fleet vehicles. And separately, and more importantly, of course, is margin expansion. I believe that autonomy is a killer app when it comes to transportation. I think that they will have higher margins because of that. So answer your question, David, I think it's 2027, and I think that's going to get progressively discounted in the stock over the next year.
What about the humanoid robots? How do you factor that into the valuation, total addressable market, and potential for profitability, or is it just too early?
It's not too early for investors who have a 5-year time window. And think of this as the AI cake. There's 3 layers to it. The first is just FSD. The second layer, I said that's probably 26, 27. The second is fleets. That's probably 27. And then the frosting layer, the sweetest layer on that is Optimus. At this point, it is an eye roller, a potential punchline of a joke for many investors, but Optimus does hold an opportunity that could create more value than the collective business altogether. And when you think about the concept of really automating work across the board, I think that that is a massive opportunity. This is still an $800 billion company. There are $3.5 trillion companies that I think are doing less to advance humanity. And so I think that Optimus should be part of the conversation, although it's not today.
Even though the recent Tesla stock run was interrupted thanks to reports saying that CEO Elon Musk is planning on postponing the company's robo-taxi event, there are many reasons to remain bullish on Tesla, as the date of the event doesn't really matter as long as the company delivers its promised robo-taxis. Say what you will about Musk, but there's no denying that investors who bought and held Tesla over the years greatly benefited, and the company has proved short sellers who bet against it wrong more than once, leading them to lose billions. Tesla's AI focus is very apparent, so postponing the robo-taxi event doesn't really matter when you look at the bigger picture. For instance, Tesla's Texas Gigafactory is constructing a massive GPU warehouse to house over 350,000 NVIDIA GPUs, aiming to centralize AI development under Tesla. And this comes after the automaker announced that it plans to invest from $3 to $4 billion in AI hardware, which highlights Musk and Tesla's commitment to becoming AI market leaders. In addition to that, the company isn't just developing AI for its autonomous vehicles, as Tesla is developing a humanoid robot, the second generation of which recently debuted at the 2024 World AI Conference in Shanghai. The company is also betting big on the energy industry, as its energy division has seen rapid growth recently. In fact, Morgan Stanley analysts recently increased their price target on Tesla stock because of the company's energy business. This is for good reason, as the company reported that, in Q2 of this year, it deployed 9.4 gigawatt hours of energy storage, which is a record for the company, but pales in comparison to what is expected soon. Tesla investors should know that it's not just about the cars, or FSD. Rather, it's about the batteries, superchargers, and AI. Things that Tesla is now doing and will still do in the future. And this is why we think that Tesla stock remains a strong buy today. But what do you think about Tesla stock? Is it a buy at the current price? Let us know your thoughts in the comment section. And don't forget to tell us what your valuation for Tesla is. If you would like to know what companies like Tesla have been up to these past few days, go ahead and click on the next video on your screen. See you there.